Hello everyone, hope you all are doing well. Uh, you, you can remember in the last class we discussed about regulatory framework for financial accounting standards in Bangladesh and around the world, and need for harmonization of accounting standards for accounting practices and reporting. Today we shall cover the new chapter B 1.4, input stage of accounting information systems, and in this chapter we shall cover double entry system, accounting equation and its elements, tabular analysis of transactions, golden rule of debit and credit, journal entries, special journals, petty cash statement, and source document. So let's start with the concept of double entry system. You know, every business transaction has dual effects on the financial status of that business. To capture those effects in accounting, we follow double entry system. This double entry system is a method in which both the effects of each transaction are recorded such that the sum of assets equal to the sum of the company's liabilities and its shareholders' equity. In double entry accounting, an increase in assets account or accounts is compensated by the decrease in other asset account or accounts, or by an increase in the liability account or accounts, or equity account on accounts, or both, and vice versa. For example, Korim Enterprise borrowed Taka 1,50,000 from a bank for 3 years. Here, Korim Enterprise should increase its liability by Taka 1,50,000 on one side, and at the same time, they do have an increase in asset in the form of cash of the same amount. So, borrowing money is having not only one effect, that is liability, but also affecting the asset, that is cash of the business. This ensures that the accounting equation always stays in balance, assets equal liability plus equity. So, the key features of double entry system is that it captures dual aspect, that means every transaction affects two sides, and it helps ensure the trial balance tallies, and it shows both the source and use of fund, and enables the preparation of profit or loss account and balance sheet accurately. Then next issue to discuss is accounting equation. Accounting equation is originated from the logic of the double entry system, which says that every transaction has a dual effect. Whenever something is received, something else is given up. There are two accounting equations. One is basic accounting equation, and it indicates assets equal to liability plus owner's equity. And another one is expanded accounting equation. This equation indicates asset equals liability plus owner's capital minus owner's drawings plus revenue minus expenses. So here are some examples of assets, liability, owner's equity, revenues, and expenses. Here, cash, account receivable, equipment, buildings, etc. are example of assets. Loans, accounts payable, then salaries and other payables are liabilities. Drawings, dividend, share capital, return earnings, these are the examples of owner's equity. Sales or service revenue, interest revenue, rent revenue, these are the examples of revenue. And cost of goods sold, supplies expense, salary expense, depreciation expense, these are the examples of expenses. So this is the list of elements of accounting equation and examples of different elements. So let's do an exercise. Here equation is given, and we need to find out the missing values through using the accounting equation. For example, for the company P, the beginning assets and liabilities values are given. We need to identify what is the value of owner's equity on January 1, 2024. So if we use the accounting equation and we deduct the liabilities from the assets, then we will get owner's equity as 32,000. Similarly, at the end of December 31st, 2024, the value of liabilities and owner's equity are given. So we can determine the value of the asset equal liability plus equity. That means the asset value will be 60,000 plus 40,000 equals 1 lakh taka. And finally, in case of C, the missing value is additional investment during the period. So here we shall use a accounting equation. For example, the equation is beginning equity plus additional investment minus drawings plus revenue minus expense equal ending equity. So if we put this information in the equation, then we will get that the additional investment during the period is only 6,000. So using this accounting equation, we can determine the other missing values in this table. So next question is, what are the purpose of accounting equation? The main purpose of developing the accounting equation are to maintain the balance in account. That means it acts as a check that debits and credits are equal. To show the financial position of the business at any point in time. to help in analyzing transactions, that is showing how each events affect assets, liabilities and equity, to serve as the foundation for preparing financial statements like balance sheet, to support accuracy and integrity in the double entry system. So in short, the accounting equation provides the structural backbone of financial accounting, ensuring that every transaction keeps the company's financial story consistent and balanced. So we can conclude that after giving the entries of each transaction, assets of entity will be equal to the total liabilities and equity. So let's check whether this equation remains valid or not after showing the effects of each transaction. We can check it through tabular analysis for each transaction. So next issue is tabular analysis of transactions. Let's start with an example. Mr. Islam started the Islam repair shop on 1st May 2024, introducing Taka 35,000 as capital, and he has other transactions during the month. So let's check the impact of these transactions on accounting equation. So the first transaction was he has invested Taka 35,000 and his capital consists Taka 20,000 as cash and equipment or Taka 15,000. So in the accounting equation, we have to put this information under the column cash, Taka 20,000, and under the column equipment, Taka 15,000. And then we have to put Taka 35,000 as capital under the broad heading owner's equity. So if you check, the total asset is 35,000 and owner's equity is 35,000. The second transaction is paid 1,000 cash for store rent for the month of May. So he has paid Taka 1,000 as rent. So it is an expense and the cash has been decreased. So we have to minus the cash 1,000 Taka from the remaining balance, and we have to show this expense under the column expense column, and we have to deduct it from the owner's equity. So after putting this information, you will find that the total cash balance is 19,000, equipment is 18,000, and capital is 35,000, but expense is 1,000 less. So total asset is 34,000 and equity part is 34,000. The next transaction is purchase a new equipment for Taka 12,000 from Lawrence Auto Parts Limited, paying 40% cash and signing a 6-month 12% notes payable for the remaining balances. So here you have purchased a new equipment and you have paid cash and you have incurred a liability. So you have to deduct Taka 4,800 from your remaining cash balance. You have to add a new equipment and you have to put this information under the column equipment, and you have incurred a new liability, it is called notes payable, and you have to put 7,000 Taka under the column notes payable. So if you check the slide, you will find that the cash balance is now 14,300, equipment balance is 27,000 and liability is 7,000, and the net balance of owner's equity is 34,000. And if you sum, then you will find that total asset equals total liability plus owner's equity. Next, go to the next transaction on May 5. Here the Islam repair shop paid 1,200 for 1 year accident insurance policy. That means you have given 1,200 Taka as advance for getting the insurance policy. So you have to deduct 1,200 Taka from your cash balance and you have to show this advance amount as a asset. So you have to include a new column as prepaid insurance or prepaid expense, and you have to put 1,200 Taka under the prepaid insurance and you have to deduct 1,200 Taka from the cash balance. Similarly, on May 8, the Islam repair shop receives bill from the daily newspaper for advertising the opening of the repair shop, Taka 600. That means you have incurred the expenditure but you have not paid this amount yet. So it's a liability. So you have to put another column here, accounts payable, under the liability head, and you have to put this 600 under this accounts payable column, and you have to put this information as an expense under the equity part. Next transaction is on 12th May. Here the Islam repair shop provided repair service to Hi-Fi Electronics, Taka 6,000, but out of this 6,000, 60% is cash and 40% is on account. So you have received 60% of this service amount, that means 3,600. So you have to increase your cash. You have to add a new asset that is called account receivable, because you will get the money from the customer in future. So this is your asset, and you have to add a new column under the account receivable column, and you have to put this information in 2400 here. And as you have provided service, your revenue has increased, so you have to put this 6000 taka under the heading revenue, under the border heading owner's equity. Next event is on May 15, hire a secretary at a salary taka 1000 per month who will work from next month. Look at this is not a transaction, this is an event, because due to this event no financial condition has been changed, so we do not need to put this information in the accounting equation. The next information is given here, like on May 17, made a contract with a client for service to be provided on June and collected already taka 3500 on cash. That means you have received advance cash from the customer, but you have not provided him the service yet. So this is your liability. So you have to insert a new column, unearned revenue, under the liability heading, and you have to put this 3500 amount under this column. And as you have received money, so you have to add this 3500 under the column cash account. Next transaction is on May 22. Islam Repair Shop collected taka 1000 of remaining balance due from Hi-Fi Electronics. So it has increased your cash balance, so you have to put this information under the column cash, and you have collected this amount from the customer, so you should deduct it from the accounts receivable column. Then next transaction is on May 26. Islam Repair Shop paid 400 on account for advertisement incurred on May 8. So you have to deduct cash amount from this balance, from the cash balance, and as your liability has decreased, you have to deduct 400 from the accounts payable column. The next transaction is Islam Repair Shop took a bank loan from United Islamic Bank for 3 years amounting taka 20,000 at the rate of 10%. So your cash balance will increase and you have incurred a liability. So you will add this amount under the column cash, and you have to insert another column under the liability heading, and it is called bank loan. Then you have to include this 20,000 as cash, and you have to include this liability as bank loan under the liability column, and you have to put this information 20,000 under the bank loan column. And the last transaction is from the shop Mr. Islam withdraw taka 1000 from the business for personal use. So 1000 taka will be deducted from the cash balance, and this is drawings by the owner, so you have to deduct this amount from the capital column. And now if you check the balance of all these columns, then you will find that the cash balance has total 39,700, equipment has balance 27,000, prepaid insurance is 1,800, accounts receivable is 1,400. The liability under the liability column, notes payable column includes amount taka 7,200, accounts payable includes taka 200, unearned revenue include taka 3,300, and bank loans taka 20,000. And under the owner's equity column, the capital column consists of amounting taka 34,000, revenue account consists of taka 6,000, and expense column consists of taka 1,600. As we have put all the information in the tabular format, now we need to check whether total assets equals to total liabilities or total equity. So if you sum all columns under the head assets, then you will find that the summation of total asset is 69,300, and total sum of liabilities is 30,900, and total sum of owner's equity is 38,400. So if you check, then you will find that total asset equals to total liability plus owner's equity. Our next topic is golden rule of debit and credit. Every business records hundreds of financial transactions, cash receipts, payments, purchase, sales, expenses, etc. To keep all these records accurate and meaningful, accountants use a scientific system called the double entry system. The double entry system has two aspects. One account is debit and another account is credit. This ensures that the accounting equation assets equals to liabilities plus equity always stay in balance. But to know which account to debit and which to credit, we follow what we call the golden rules of accounting. So assets and expense account will be debit when assets and expense accounts increase, and it will be credit when asset and expense account decreases. On the other hand, equity, income and liability will be credit when it or these types of account increase, and this will be debit when the equity, income or liability account decreases. Let's check an example. Islam Repair Shop took a bank loan from the United Islamic Bank for 3 years amounting taka 20,000 at the rate of 10%. So here the cash balance of the company has increased and a liability has incurred. This is called bank loan. So we have identified the two accounts, and here one is cash, that is asset. So asset has increases, so it should be debit, and on the other hand loan is a liability and liability has increased, so it should be credit. So the journal entry should be cash account debit and loan account credit. Next topic is general journal. In the previous lecture, we discussed about accounting cycle, and we mentioned that after identifying the transactions, you have to record the transactions, and this is called journal. So what is general journal? Actually, analyzing transactions and recording them as journal entries is the first step in the accounting cycle. It begins at the start of an accounting period and continues during the whole period. An accountant first analyzes a transaction to determine whether a particular business event has an economic effect on the assets, liability or equity of the business. It also involves ascertaining the magnitude of the transaction, that is its currency value. After analyzing transactions, accountants classify and record the events having economic effect via journal entries according to debit and credit rules, as we have mentioned already. The business transactions are recorded chronologically in a journal, each one with a short description. A record of a single transaction in a journal is called a journal entry. In the screen, you can see the format of general journal. There are total 5 columns. One is for date, another one is for account titles and explanation, and one is for reference, and there is a debit column and credit column. Maybe you can remember in the earlier discussion we discussed about Islam Repair Shop, and there are some transactions during the month May. So we now check to the journal entries regarding these transactions. The first transaction was Mr. Islam started the Islam Repair Shop on 1st May 2024, introducing taka 35,000 as capital, and his capital consists taka 20,000 cash and equipment taka 15,000. As he has invested as capital, so capital will increase, so capital will be credit, and he has brought cash taka, so cash taka has increased in the business, so cash account will be debit, and equipment has increased in the business organization, so equipment is an asset, so it should be also debit. So the journal entry should be cash account debit 20,000, equipment account debit 15,000, and Islam's capital account credit 35,000. The next transaction was Islam Repair Shop paid taka 1,000 cash for store rent for the month of May. So here the store rent is an expense. Expense has increased, so it should be debit, and cash account has decreased, that means asset has decreased, so it should be credit. So the journal entry should be rent expense account debit 1,000 and cash account credit 1,000. The next transaction was on May 3. Islam Repair Shop purchased a new equipment for taka 12,000 from Lawrence Auto Parts Limited, paying 40% cash and signing a 6-month 12% notes payable for the remaining balance. That means he has purchased a new equipment, so asset has increased, so equipment account should be debit. Islam Repair has paid 4,800 taka, so cash has decreased, that means asset has decreased, so cash account should be credit, and it has incurred a liability called notes payable, so liability has increased, so it should be credit. So the journal entry should be equipment account debit 12,000, cash account credit 4,800, and notes payable account credit 7,200. On May 5, Islam Repair Shop paid taka 1,200 for 1-year accident insurance policy. So it is an advance payment. So this advance payment should be considered as an asset. So as asset has increased, so prepaid insurance account should be debit, and cash has decreased, so cash account should be credit. So the journal entry should be prepaid insurance account debit 1,200 and cash account credit 1,200. The next transaction was on May 8. Islam Repair Shop received bill from the Daily News for advertising the opening of the repair shop, Taka 600. This is an expenditure for this organization, but the amount has not been paid yet. So it's a liability. So the journal entry should be advertising expense account debit 600 and accounts payable account credit 600. The next transaction is on May 12. On May 12, Islam Repair Shop provided repair service to Hi-Fi Electronics, Taka 6000, and 60% in cash and 40% on account. As it has received Taka 3600 cash, so asset has increased, so cash account should be debit. It has 2400 amount due to a customer, so it should be considered as account receivable, and as asset has increased, so account receivable account should be debit. And Islam Repair Shop has provided service, so revenue has increased, so service revenue account should be credit. So the journal entry should be cash account debit 3600, account receivable account debit 2400, and service revenue account credit 6000. On May 15th, Islam Repair Shop hired a secretary at a salary of Taka 1000 per month who will work from the next month. So as we have mentioned already, it is not a transaction, so we do not need to put any journal entry for this event. Then the next transaction occurred on May 17. Islam Repair Shop made a contract with a client for service to be provided on June and collected Taka 3500 cash. It has already collected 3500 Taka in cash. So cash has increased, that means asset has increased, so cash account should be debit. And it has not provided the service yet. It should be provided in the next month, but I have received the cash, so it's a liability. So Islam Repair Shop should recognize this as a liability, and as the liability has increased, so it should be credit. So the journal entry should be cash account debit 3500 and unearned service revenue account credit 3500. The next transaction occurred on May 22. Islam Repair Shop collected 1000 of balance due from Hi-Fi Electronics. As it has received cash, so asset has increased, so cash account should be debit, and as it has collected from the customers, that means the remaining balance from the customer has decreased, that means asset has decreased, so account receivable should be credit. So the journal entry should be cash account debit 1000 and account receivable credit 1000. Then on May 26, Islam Repair Service paid Taka 400 on account for advertisement incurred on May 8. That means liability had decreased. So the journal entry should be accounts payable account debit 400 and cash account credit 400. On May 29, Islam Repair Shop took a bank loan from United Islamic Bank for 3 years amounting Taka 20,000 at the rate of 10%. So as it has taken a bank loan, so liability has increased and cash has also increased. So the journal entry should be cash account debit 20,000 and bank loan account credit 20,000. And the last transaction was Mr. Islam withdraw Taka 1000 from the business for personal use. So it is a drawings. So the drawings account should be debit as capital has decreased and cash has decreased, so cash account should be credit. So the journal entry should be drawings account debit 1000 and cash account credit 1000. So this is the summary of total transactions in the journal book. Our next topic is special journals. Think about a business that conducts numerous sales on a single day. Providing journal entries for each of the sales transactions is quite tedious. Instead, keeping records of all the sales in a separate place and providing one entry of the total sales figure may help to reduce workload. The process of accumulating similar transactions in one place to process in a batch for the total sum is called a special journal in accounting. Grouping similar transactions are usually required for sales, purchases, cash receipts, and cash disbursements. Special journals for sales, purchase, and cash substantially reduce the number of entries that companies make in the general journal. Only transactions that cannot be entered in a special journal are recorded in the general journal. For example, a company may use the general journal to record such transactions as granting of credit to a customer for a sale return or allowance, granting of credit from a supplier for purchase returns, acceptance of a note receivable from a customer, and purchase of equipment by issuing a notes payable. Also, correcting, adjusting, and closing entries are made in general journal. So there are mainly 4 types of special journal, one is cash journal, another one is purchase journal, cash receipt journal, and cash payment journals. And other entries are usually recorded in the general journals. So let's define the sales journal first. In the sales journal, companies record sales of merchandise on account. Cash sales of merchandise go in the cash receipt journal, and credit sales of assets other than merchandise go in the general journal. Next topic is purchase journal. In the purchase journal, companies record all purchases of merchandise on account. Each entry in this journal results in a debit to inventory and a credit to accounts payable. Next topic is cash receipt journal. In the cash receipt journal, companies record all receipts of cash. The most common types of cash receipts are cash sales of merchandise and collection of accounts receivable. Many other possibilities exist, such as receipt of money from bank loans and cash proceeds from disposal of equipment. A 1 or 2 column cash receipts journal would not have space enough for all possible cash receipt transactions. Therefore, company use a multi-column cash receipt journal. And the next and last special journal is cash payment journal. In the cash payment journal, the companies record all disbursement of cash related to purchase of merchandise items. Here is an example of cash receipt journal. Here, the company has received different types of cash in different dates. For example, on April 5 from sales, and on April 7 from a customer, and on April 7 from a sales, and on April 8 from the owners of the business organization. So in the cash receipt journal, the company will record all cash receipts in the cash column, and it should also record the other columns. For example, here on April 5, the company has sold merchandise elements on cash, so it has recorded here cash debit and sales account credit. And next, on April 7, it has received from a customer taka 15,000, so it has recorded cash on the cash column and credited the account receivable column. Like this way, the company record all the cash receipts in the cash receipt journal and all cash payments in the cash payment journals. Our next topic is petty cash statement. In a day-to-day business, you may need to deal with several small and routine cash expenditures for which writing a check is not meaningful. For instance, you have received postage for which you need to pay only taka 20 for courier charge. Writing a check for that may not be effective, rather a small amount of cash may keep available on hand with the cashier to meet these expenses. This cash is known as petty cash, and the book used to keep these records of the transaction is called a petty cash book or petty cash statement. Providing journal entry for these frequent but insignificant transactions may unnecessarily increase workload. Instead, recording all these transactions in the petty cash book and processing the total sum of various such expenses at the end of the period may provide a meaningful and efficient solution. You may transfer a lump sum fund to the petty cashier periodically to handle the small expenditure, and later may cross-check the vouchers for payment and the cash availability. To continue the process, you may transfer again another amount to the cashier. So the key features of petty cash is: petty cash is a part of the total cash in hand and can be considered as a sub-account of the main cash account. This cash is used for a small expenditure for which it is hard writing a check and recording their trail. Maintaining petty cash, particularly in large establishments, is significant for efficient and smooth day-to-day operations. Maintaining petty cash helps to avoid lengthy process of making checks, and usually this cash is used for daily postage, supplies, small travel expense, etc. Let's do a practice. Suppose XYZ Enterprises maintains a petty cash under the Impress system. The cashier is given taka 1000 on 1st April 2021, and transactions for the month related to petty cash are given below. Here on April 2, it pays 20 taka for postage stamp. On April 2, it again paid taka 50 for office supplies, and on April 7, it paid peon for traveling, and on April 20, it purchased revenue stamp for taka 20, and then on April 25, it purchased kitchen supplies for taka 100, and on April 30, it pays taka 80 for office supplies, and these transactions should be recorded in the petty cash. as we have mentioned, the cashier was given taka 1000 on 1st April 2021. So on the receipt column, it should write the 1000 amount on April 1. Then it has paid different expenses on different days, and these expenses should be recorded in the total column and then also in the individual columns. In the petty cash book, there might be different columns, for example, the amount received and the total expenditure, and then you can also add some columns for the other expenses. In the receipt column, you should write the amount you received on the first day of the month from the business organization. Here it is given only 1000 taka. Then you have paid different amount for different purposes in the different date, and in the total column we have written the amount along the particulars, and in the stamp and supplies and traveling columns we have also written the amount for that particular expenditures. So at the end of the month we find that total expenditures was taka 3000. We started taka 1000 and the total expenditure is 300, so the balance is 700. So in the next month you will get from the business organization taka 300 again, so the remaining balance will be 1000. So in this way the petty cash is maintained in a business organization. So the next topic is source documents. Here you can see the list of different types of source documents. In case of sales journal, purchase journal, cash receipt journal, and general journal, we give transactions. For recording the transactions in the sales journal, purchase journal, cash receipt journal, cash payment journal, and general journals, we need such source documents. So here is the list of source documents. You can find the sales invoice acts as a source document for sales journal, and debit note and credit notes acts as a source document for the purchase return journal and sales return journal, and invoice, bills, vouchers, etc. actually works as a source document for the general journal. And these source documents actually help us to record the journals in proper way. So that's all for today. Thank you. See you next class.